Hey, what's going on? You know who it is. It is Bruce Jordan, the Michael Jordan of hotels. And as usual, I keep Scottie Pippen with me.
I was thinking the same thing, big dog. Let me feed you.
Brandon is back in the building. What's going on, man?
What's going on, man? How you doing?
Pretty good, pretty good. Hanging in there. It's been a minute.
It has been a long time since I've last seen you, sir.
Yeah, because I screwed up our last interview by having bad audio.
Oh, it'd be like that. We look good. We don't always need to sound good.
There you go. There you go.
We got one of the two working for us.
That's it. That's
yes,
it.
Yes, sir.
Today we're going to be talking about hotel ownership and what you should do or should know before you choose a franchise for your property.
Yes, sir.
Man, do you know a little bit about that?
I like to think so. I played Monopoly as a kid, so I like to think I know what you should do before you build a hotel on a piece of land.
There you go, because
yes,
Marriott is in the building.
We are. We definitely are.
Hohokon. Okay, okay.
I like to change that. Not only are we in the building, we are the builder.
That's it. That's
yes,
it.
sir.
That's it with all the keys, the most expensive keys in the market.
That provide the best return.
That's right.
Yes,
that's
sir.
right.
Yes, sir.
I can't disagree with that one. Man, that's one strong reservation system.
It is.
Bonvoy
is a great engine. Brands get a lot of direct brand contribution. That's something that owners definitely want to get today, especially in today's time when the cost has gone up. You definitely want to have an engine driving reservations to your hotel.
Yeah. What challenges? I see, you see what's going on in the rest of the market.
Yes, sir.
And it's a good thing Marriott doesn't have a lot of the challenges like a lot of other hotels have.
Yep.
But what are some of the challenges you're seeing with hotel ownership in the market right now?
I like to put it this way. It's not that we don't have those challenges. We see the same challenges as our competitors. We don't have to talk about their names, but we have the same challenges. The thing that helps us out is that we're more resilient. We've been built up organically to be able to better sustain those challenges than some of our competitors. We've been a leader in a lot of market demand and segments. So we're not chasing the things like some of our competitors are today, which allows us to stay true to who we are. And ultimately our guests know that we're going to stay true to them as well. As old Marriott man said, if you take care of the guests, they take care of the profits.
That's right. That's right. Now, we have new hotel owners coming into the game.
Yes, sir.
And everybody wants Marriott right away. Even if they're not ready or not, they're I want a Marriott.
Yes, sir.
That's their dream property.
It is. Yeah.
What are some of the challenges that you see them face, and how do you resolve those challenges before it becomes an issue?
Number one is you don't want to ever oversaturate a market. You know, Marriott, we have a lot of different brands, more than 35 now in our portfolio. And some of our competitors think, oh, Marriott has too many different brands. But what they fail to realize sometimes is that we have a lot more brand delineation than our competitors do. When you think about the Fairfield brand, traditionally speaking, there was our lowest brand in our segment in the mid-scale space. If you step above that, you have SpringHill Suites, which is about a $15 RevPAR difference between the Fairfield and the SpringHill. If you step above that again, you go to the AC Hotel. Nationally, it's at about $160 RevPAR. So then you're talking another $50 RevPAR jump to go from the SpringHill brand to the AC. And a lot of times owners are like, hey, well, I think because the courtyard's doing well, I want to do another courtyard. And they don't recognize, well, there may not be enough courtyard reservations demands in that market. And that was the first thing that I've learned that we have to educate some of these owners on. It's not like going and saying, well, we can have 7 Starbucks in the same market. We can have 13 McDonald's. The hotel space is a little bit different in that regard, that it's a lot more capital intensive to go inside of that. So we really try to educate them on the market demand drivers and ultimately what their returns can be if they develop a new hotel.
Nice, nice. Now, AC Hotel's actually been pretty hot.
It is.
I stayed in one in Fort Lauderdale Airport, and I'm like, what? I'm looking at the design,
They're very nice.
I'm like, what is going on here?
Yes, sir.
I may need to capitalize on this myself.
Yep. Yes, sir.
The next thing is everybody talks about the franchise agreement. Every franchise agreement is different.
Yep.
What makes your franchise agreement better than the competition?
I would say that's relative. It's hard to say that our franchise agreement is just better. I would say I think it better suits the owners that want to be Marriott franchisees, because what makes a good Marriott franchisee isn't directly what makes a good Wyndham franchisee. And I'm not disparaging those people. It's that what makes Best Western good, they have those yearly memberships, right? If an owner says, hey, I want the flexibility to maybe go from this brand to the next, Best Western traditionally has always said, hey, we're going to allow you to do that. I like to say it this way. You date our competitors, but you marry Marriott.
That's right.
We don't have those 5-year, 10-year outs. If you're going to do a deal with us, we want to be committed in that relationship for the 20-year, for the entire life cycle of that franchise agreement. So if you're a person that loves to buy an asset and hold an asset, then I would say the Marriott franchise agreement is better for you. But if you're a person that wants to get into something and flip it to the next, maybe our competitors like a Choice or a Wyndham or Best Western will be better suited for you because they're going to have those 5 years out or ultimately that 1 yearly membership agreement.
And then you got to talk about the value of the hotel as well. I mean, the value of the hotel.
Yes, sir. Yes,
it's going to be a much stronger sell. They're going to get a higher price with the Marriott than it would
better cap rates.
Yeah,
absolutely. I do agree. But at the same time, we're more labor intensive because our guests expect a more premier, more premium experience. And so where some of our competitors may not have the same top line revenue. They like to tell owners, well, you have a better flow through. We definitely disagree with that.
Of course.
But we also believe that, again, going back to Mr. Marriott, if you take care of your employees, they take care of those guests. And the only way to take care of them is to staff them, give them the support that they need. So yes, we trade at a better cap rate, we trade at a higher price, but we're also more labor intensive to operate as well.
Can you break down the cap rate for some of the newer hotel owners that they don't understand, like what's the difference in cap rate for something like an apartment complex versus a hotel? And I know you have this conversation all the time.
I do. But again, it comes down to it's a different capitalization model. If you're wanting to get into multifamily, you're really saying, hey, we want to have a room. We want people to rent those rooms. We don't want to clean those rooms. We really want to just collect a check and manage the property from the outside. The hotel model is different. It's not just a real estate play. It's a service model with inside of real estate, because we're going in there, we're cleaning those rooms every day. And so when banks are lending and they're trying to trade things, it's like, hey, you're not just buying an asset where there's rooms and beds. You can do that by buying a furnished apartment. What you're buying into is that Bonvoy reservation system that they're saying, hey, it's driving reservations straight to here, that these owners don't have to rely on OTAs, which then lends to giving a better cap rate to the owners versus some of our competitors, because the lenders are saying, wait a minute, we know Bonvoy is doing his job, so it's not as much of a risk if we're allowing them to buy and trade this Marriott hotel than it is some of our competitors that may only have a 15 or 20% direct brand contribution.
Now, I was told that the actual trade name it goes on the balance sheet for that particular hotel.
Okay.
Now, how does that work?
Explain that again. I'm
the Marriott trade name, like when you have that trade name, it goes on the balance sheet on the accounting side.
Because it's not just the asset itself. It's that when you're trading that hotel, it's encumbered with an actual brand. So if XYZ owner says, hey, I own this Fairfield, I've owned it for 7 years, maybe I don't want to do the refresh, I now want to sell this hotel to the next owner. The next owner's coming in and saying, well, I have to do the PIP. And I have the flag for the next 13 years. They have to keep the flag. A lot of times what they'll try to do is negotiate with us, say, hey, I'm going to spend this $2.5, maybe $3.5 million on this refresh PIP. I'd like to get an extension on the franchise license agreement. We're fine with that because, hey, we're getting a newer asset, if you will, because it's going to be refreshed, and we'll extend that term out for another 7 years. In essence, giving them another 20-year franchise license agreement. And so when they're picking up that hotel, it's going to say that this building is a Marriott hotel, so it is going to be on that sheet. Yes, sir.
Man, and how does that work out when it transition over to financing? It's got to be a lot easier to get a financing deal with Marriott.
I do believe, and I think our lenders out in the space say that it's easier as well, because again, it always comes down to the risk factor. Banks want to be able to take on the least amount of risk while simultaneously getting the best return. But we understand this, we're in business, we understand, but a lot of times if the risk is higher to you expect to get a higher return. And that's the benefit that Marriott drives. We provide you low risk, high returns.
There you go.
Ultimately, that's what people want.
Man, what are some of the things that most hotel owners say about the Marriott brand when they say, hey, I'm choosing that Marriott? Like, what are the top 3 reasons why you think they're choosing Marriott that they communicated to you?
Yeah, that they tell us. Yeah. One, they want the owner's rate.
Okay.
I'm just being honest with you. They want to be able to travel and stay at Marriott hotels, because when you're traveling with just your family, most people, they may be a Choice member, they may be an IHG member, but they really want to go and be able to stay at a Marriott hotel when they go on vacation. Yeah. Choice and IHG may be their preferred hotel when they're traveling for business, but ultimately Marriott is a place where they want to stay when they're on vacation. Secondly, is just the returns. They want to be able to know that this hotel, this asset they're investing money in is going to provide a great return to their bottom line, because although we're in the business of hospitality, we're in the business of business.
That's right.
And that means we're in the business of making money as well. Which goes again, I keep reiterating this, if you take care of the guests, if you take care of the employees take care of the guests, and the guests take care of your profits. And lastly, that's another thing that I say our owners tell us is they prefer to deal with the Marriott guests when it comes to guest complaints, because they feel it's more of a high value clientele, which brings them less stress on their property employees.
And less problems.
Yes, sir. A lot less problems.
With less problem guests.
Yes,
I think that's the best way to say that.
Less undesirable guests. Yes, sir. Yes, sir. Absolutely. Bruce Jordan said that.
I'm just speaking from experience.
Yes, sir. Yes, sir.
But the number one thing that I really do see when it comes to the Marriott brand is your people.
Yes, sir.
And I think the downside of working at Marriott is that you know, as an employee, even yourself, you become like a reservation clerk for your family because they all want the discount.
That is the burden behind the blessing, my man. Hey, yo, fam, listen, I'm going to Miami for the weekend, bro. Let me get that friends and family rate, B. That happens all the time, sir. I get those calls nonstop.
Yes, yeah, I still get those calls.
I'm sure.
At 12 o'clock at night, let me tell you. So what do you think hotel owners really need to know from your personal experience before they sign on a dollar line? What do they need to look for?
Is it a question for existing hotel owners that are getting into maybe the Marriott space that haven't had a Marriott hotel, or is it people from outside of the hotel space? Which one would you like?
Outside the hotel space.
So when you're asking that question, you're talking about people from outside of the hotel space. So maybe the convenience store owner, maybe that Chick-fil-A owner is like, hey, I'm in franchising already. I like to maybe go into an asset class like hospitality. I say first and foremost, understand the financial economics around it. It's a lot more labor intensive. It's a lot more capital intensive investment, because again, you're not just sitting on an asset. You're sitting on an asset that comes with a service component attached to it. So just understand that the commitment that it's going to take to own and operate a hotel is going to be a lot different than a convenience store.
Okay.
It's not a set it and forget it feature. You're actually never off.
Yeah.
That was my guy, Philip Cologne. And he walked into the camera,
forever.
and I want him to know that when he sees this video, don't let that happen again, Philip. Pick up where we were. Boom, boom, labor intensive, capital investment. We really want them to know it's going to take a lot more work and effort to operate a hotel than it is that convenience store or that Chick-fil-A, because your Chick-fil-A store is going to close 11:30 or 12 o'clock.
That's right.
The hotel never closes.
That's right.
During holidays, we're open. During disasters, we're open. So you need to have that mindset that, hey, yes, you're here to make money. Yes, it's real estate, but you're here to serve those guests that are staying at your hotel. Yes, sir.
For sure. Well, listen, how can everybody get in touch with you?
Well, I don't have Instagram. I don't have Snapchat. I don't have Twitter, but I do have LinkedIn. My name is Brandon Ray Harris on LinkedIn, and you can associate that with Marriott Hotels, and you'll find me there.
All right. And thank you for tuning in for another episode. This is Bruce Jordan, Michael Jordan Hotels, signing out. Hey, what's going on? It's Bruce Jordan, the hotel revenue expert. I just want to take a quick second to thank you for watching this video. If you could just do us a big favor and just subscribe to the channel. We have a lot more videos like this, more information, great information about hotels. I'm also the author of the Hotel Revenue Bible. You can get that book on hotelrevenuebible.com. And we are here to answer all your questions. So if you have any questions, just shoot us a quick text at 321-321-2002. That's 321-321-2002. And you can book a revenue call. Go to hotelrevenuecall.com and we can answer any and all your questions. Just make an appointment with me. You'll do one-on-one with me. You'll be able to do one-on-one with me, and we could go ahead and get all your questions answered and see if you have any revenue issues that needs to be resolved. Talk to you soon. Thank you again. Hit that subscribe button. We really appreciate you.